And that was Fear Factory with Dog Day Sunshine. Or Sunrise. Sunrise, yeah. My apologies, it's not exactly my favorite Fear Factory song. I think that was like a cover from somebody else. I'm not entirely sure. Anywho, as far as where we're going to go today, I haven't the slightest clue. I'm just like shooting it completely from my hip. I got a few tabs, so we're not we're not like isolated out on an island with nothing to go with. But anyway, I got this thing here. It's on azcoinnews.com, and I thought this was kind of interesting. Coinshares 2019 Bitcoin mining rigs produce far more hash rate than last year's models. And this is by Dorothy, so I'm assuming no penis. This is authored December 16th, 2019. And let's see if this is actually just a preface. Okay. Coinshares emphasized that the newly introduced Bitcoin mining rigs have, quote, as much as 5 times hash rate per unit than their generation predecessors, according to the recent 2-year mining report. Furthermore, the news suggests that the semiconductor industry is going beyond 7 nanometers, 5 nanometers, and 3 nanometer processes, and is expected to design 2 nanometer and 1.4 nanometer chips by 2029 from the International Electron Devices Meeting, IEDM, that held on December 7th through 11th. Quote, as much as 5 times the hash rate per unit. At the end of 2019, Coinshares Research released its biennial mining report containing research and observational information about the Bitcoin mining industry. Since Coinshares' final report, published in June, BTC's hash rate has increased by 50 exahash per second, and the company believes that a fair share of its power comes from China. With the crypto mining market price seemingly plummeting, one would think that BTC miners will slow down. However, this happened this year, and despite the chaotic market, the BTC hash rate has grown terribly. On December 12th, Coinshares Research revealed some new statistics about the state of Bitcoin mining today, and a lot has changed since the last report. Research into Bitcoin mining trends notes that the increased hash rate is due to a combination of stronger BTC prices since a low of $3,000 and next-generation Bitcoin miners. Coinshares mentioned that the next-generation mining rigs produced by Microbit, Bitmain, Canaan, and eBank produce as much as 5 times the hash rate per unit as their generational predecessors. Between November 2018 and June 2019, Coinshares Research witnessed capital transfer and bankruptcy in the mining industry, but the past 2 quarters have seen expansion. The hash rate increase in 2019 has been exponential. For example, in 2017 through 2018, many mining rigs moved away from the 18 nanometer semiconductor standard to lower 12 nanometer, 10 nanometer, and 7 nanometer processes. Semiconductor manufacturers have a roadmap for 2 nanometer and 1.4 nanometer processes. Holy shit. The recent IEDM event of the semiconductor industry shows that ASIC miners will likely continue to improve as the year continues. One of the interesting revelations here at IEEE's International Electronics Conference, IEDM, is around new and upcoming process node technologies. Almost all sessions so far this week have involved 7 nanometer, 5 nanometer, and 3 nanometer processes. What we didn't expect to see revealed was an extended roadmap of upcoming Intel manufacturing processes. Currently, ASIC mining rigs manufactured by manufacturers such as Bitmain, Canaan, eBang, and Microbit. Is that microbed? Microbed. It looks like it should be Microbit. Mainly use 12 nanometer, 10 nanometer, and 7 nanometer chips. This means that 5 nanometer and 3 nanometer processes are consolidated over the next 2 years. Mining devices will also greatly improve. It's hard to see how fast mining rigs packaged with 2 nanometer and 1.4 nanometer chips will work, but they can be significantly faster than current machines. Moreover, the majority of mining companies are using the chip processes of the Taiwan Semiconductor Manufacturing Company, TSMC. The Taiwanese semiconductor casting plant plans to speed up processes like Intel, and potentially TSMC could be ahead of the game in that regard. No matter which semiconductor company makes better chips faster, improvements in the chip industry in general will undoubtedly push Bitcoin mining rigs to be built in the next 2 decades. Goddamn right. Let me see if I can find this fucking report. Maybe they gave us a link to it. I mean, because this is some important shit. And it's funny because, you know, there's been all this fudding about Bitcoin, Bitcoin mining specifically, is that a lot of people couldn't see this far, or aren't even bothering to look this far into the future as far as how Bitcoin mining is continuing to be the catalyst, the driver behind why are we bothering to make faster fucking chips. I mean, it's like a self-incentivized thing. You know, it's like the faster your shit is, the more money you make on it, the faster, right? Well, you know, I mean, there's a point of diminishing returns, I'm assuming, some point in the future, but we have yet to see it, and these people are planning to go even smaller than nanometers. I wonder what the next one down is. It's like angstroms or some shit. I don't know. Maybe it's smaller than angstroms. It's been a while since I've been in the industry, so you know, I haven't been that deep into it. I'm sure if I studied, I'd figure it out. But let me see if I can find this thing. Coinshares Research 2019. Give that a try here. Bring us up that. But anyway, where I was going with that is that a lot of people they were looking at mining as something that something that's bad for the ecology of the planet. And I have been arguing completely against that. And not just because I'm a contrarian, because you know I am. But beyond that, is that if you listen to what we were talking about here, when Bitcoin mining started, it was they were nowhere near this small. I mean, as far as the measurements, the size of the chips themselves in your processors. You know, they've been shrinking, but the shrinkage of them, it's been kind of accelerating, but at the same time, oh cool, I can download the report. Oh yes. Oh. No, I don't want to give you my information. Fucking shit. I hate that. But if it's gonna give me this report, I'm gonna fucking give up my fucking email address. Come on now. You know I got more than one of them. Auto direct, not click here. Come on, do it. It should auto direct, but it's not currently auto directing. Anyway, my feeling is that because of the additional incentive structure behind cryptocurrency mining, the faster the shit is, the more efficient it is, the more money you make. You know, either by saving it on electricity or heating or whatever, or cooling. Whatever iterative improvement happens in mining, it's not just happening in mining. Okay, if we make a bump in the or a drop rather in the size of the chips, that's something that's going to impact everything. That's going to impact video cards. That's going to impact your processors and your tablets and your laptops and your desktop, everything. Okay? And so when we're talking about something that is driving innovation, I would say that Bitcoin and cryptocurrencies that are terribly dependent upon the efficiency and the performance of the hardware involved, that they are an additional driver behind incentivizing people to design shit that's smaller, faster, cooler, cheaper. And this drive is going to continue. You know, we have yet to see 7 nanometers adopted by Intel as their consumer grade stuff. They're still pumping out 10 nanometer chips like it's something new. But as we heard from that little glimpse at this report that we're going to get into, and we're probably going to digest this whole thing because it's only 20 pages, and it looks like it's got a lot of pictures. So yeah, see, we're going to start on page 2 because page 1 is big old picture. The Bitcoin mining network: trends, average creation costs, electricity consumption, and sources. June 2019 update. So yeah, we're definitely going to eat this thing. But where I was going with that, and they might even cover it in this report here, is that, you know, there was all this complaining, I want to say in like 2017 and 2018, about the electricity consumption of mining. And they were like, you know, saying it was sucking up all this electricity, it's making electricity more expensive and blah, 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 blah. A bunch of fucking bullshit. Bunch of bullshit. Bitcoin mining, the process of Bitcoin mining, turns electricity and computer cycles into money. Let me repeat that. Bitcoin mining turns electricity and computer cycles into money. So when you're thinking about it in that way, you can understand why the more computer cycles my computer does, the more money I make. The faster it does them, the faster I make the money, right? But that also means the more secure the network, and so on and so forth. When you consider the total energy inputs involved in Bitcoin mining, and this is including things like actually manufacturing the processors involved, right? That when you compare it to things like the current monetary system that we have with fiat currencies, just moving physical bills alone consumes more energy every year than all of the Bitcoin mining, all of the cryptocurrency mining happening on this planet at this moment. But more importantly, like I said, this driver to be more efficient, make more money, right? It pushes the development of faster chips for us. But I've said this multiple times on this show, and not recently, but when an improvement happens anywhere in kind of in anything involving computing, right? If there is an iterative improvement in the size of channels, channel lengths, things like that, just little architecture improvements, they are not just applied in that place where that R&D pickup happened. You know, so say TSMC makes some whiz-bang fucking discovery about caching or something like that. Well, TSMC doesn't just make mining chips. They make chips for things like video cards and tablets and laptops and desktops. They make die for all of these chipsets. And so again, they're not just going to apply that little efficiency upgrade. If it moves one chipset from a 10 nanometer die set down to a 3 nanometer die set, they're going to apply that iterative improvement to everything on their fucking processors. Because just retooling alone, okay, converting the machines to where they are processing from 10 nanometer chips down to 3 nanometer chips, that shit takes months. So what are you going to do? Are you going to continually retool your shit back from 10 nanometer to 3 nanometer to 7 nanometer? No. You're going to convert your fab and retool it down to a 3 nanometer fab, and you're going to process everything. All of the dies are going to be 3 nanometer measurements. And so if they've got a roadmap for this, they're already planning the tooling for it. They're already planning, they're looking at how many factories they have and where they're at, deciding which ones can actually handle the demand, the load, and they're saying to themselves, which one can we retool the fastest, and so on and so forth, right? But like I said, if Intel, if they retool from a 10 nanometer plant down to a 3 nanometer plant, they're going to be doing a lot more than just making, what is it? I can't even remember their current big chipset that they're doing. But anyway, the point being that they've always got multiple places going, because not every laptop they put out has the latest and greatest. Some of them have the Celeron, some of them have the Xenon, and this is all according to spec. That the customer wants or needs or whatever. And they do always improve, but they don't always improve like to the same iteration. Nonetheless, this progression, there's always a bleeding edge to it. And right now, I think that Bitcoin mining and cryptocurrency mining are on that bleeding edge. It used to be things like video, right? And it still is to some extent. I mean, like ray tracing stuff. If you look at some of the games that they've re-rendered with ray tracing, looks fucking amazing. Fucking amazing. Really taking advantage of the video capabilities of our HDMI and all that other shit. But the point I'm getting to there is that all of the improvements that we're seeing in Bitcoin mining, they're going to translate down to everything else. And I think that we're going to see them more and more in Bitcoin mining and cryptocurrency mining first. And the underlying effect of all of this is that all of our electronics are going to get more efficient. They're going to use less electricity, but they're going to produce a better output at the same time. And like I said, I really credit cryptocurrency mining as being a big driver, because again, it's one of the fastest transitions. You don't have to like make a movie with it and then make the money on the movie, right? You just plug it in, run a program, and it makes money. It's a whole different process. Anyway, let's go ahead and throw back down into some music for a moment, because I mean, this thing's 20 pages, and I'm probably going to take it all down at once. So I've been wanting to play some Vola, and let's see here. There it is. The Same War, Vola, here on Coin Metal. And that was Strapping Young Lad with Oh My Fucking God. So, as far as what we're going to get into tonight, and it took me a moment to figure it out, but I think this is it. The Bitcoin mining network, trends, average creation costs, electricity consumption, and sources. And this is a June 2019 update. And this is from the Coinshares Research Group. Forward. The Bitcoin mining industry is opaque, mysterious, and misunderstood. But the health of the network supporting Bitcoin through mining is critical, vital actually, to the protocol. There's a lot to talk about investing in Bitcoin, trying to build a parallel financial system atop Bitcoin, using Bitcoin for payments, or a safe haven store of value. But there's not enough attention being paid to securing the underlying network. Despite its outsized importance, there are serious questions around mining that have not been answered. Bitcoiners yearn for decentralization, but mining is still relatively centralized. To reach the decentralized future we all hope Bitcoin can achieve, and to understand Bitcoin at all, we need to understand that the Bitcoin mining ecosystem. The need for adequate research in the Bitcoin mining network is imperative, but also no small feat. Collecting data points, trends, and estimates on the dynamics and economics of mining is nearly impossible without extensive on-the-ground research. In such a secretive place, Coinshares stands out for their in-depth research on this topic. At Fidelity's Center for Applied Technology, we believe the future of financial services will take place on open and permissionless ledgers like Bitcoin, but to truly understand the space requires rolling up your sleeves and diving deep into the technology. To understand Bitcoin mining, we knew we had to mine ourselves. Since the inception of our mining efforts in 2016, we have taken this, quote, learn by trying approach. As soon as we set up our first miners in a small shop at our office, we realized that the mining industry is in a state of constant change. Over the past year, we have expanded our mining efforts to ramp up our knowledge of the space. We've explored optimal locations, hardware procurement, mining farm setups, and the economics of the mining industry as a whole. Two interesting developments covered in the report are the insolvency of mining companies during the bear market and the new trends in mining hardware manufacturing. It seems that every time we examine mining, we find ourselves on a new frontier, with miners and manufacturers uncovering new ways to optimize and compete. But the more things change, the more they stay the same. As Coinshares continues to highlight, chasing down the cheapest power remains the cornerstone of capturing competitive edge in Bitcoin mining. Power is the single complexity of the mining ecosystem that can be controlled or confined. You may not be able to control hash rate, price, or hardware costs/specs, but locking yourself into an advantageous electricity contract will allow for flexibility and profitability. Mining is a profit-driven competition, but its most important function is securing the Bitcoin network. Anyone seeking to build a business around Bitcoin or investing in its long-term value proposition has an incentive to maintain the integrity of the Bitcoin network. So, as you hunt for nonces, we encourage miners to remember their utmost goal: securing Bitcoin for the future. The better we all understand the mining industry through cooperation and transparency, the stronger Bitcoin will be. And this is by Armanda Fabiano, Fidelity Center for Applied Technology. Oh, this shit is from Fidelity. Yeah, they've been involved in mining for quite a while, and I gotta say, out of all of the institutional level investors that have come into the cryptocurrency space, I think theirs is probably the most serious approach to it. You know, all these monkeys are talking about, oh, we're going to make our own stable coin, or we're going to make our own ETF, or we're going to make our own payment system that fits on top of Bitcoin. They're like, no. We want to understand this shit from the guts on up, meaning we want to participate how you're supposed to. We want to be nodes on the network. And like I said, I think that's the ballsiest fucking approach out of all of these institutional grade guys. If I were to put my money with anybody, it would probably be Fidelity, because they're getting the intrinsic knowledge that is going to back up their investments. You know what I'm saying? This isn't a commercial for them. I don't get paid by anybody to do this show. Just letting you know. Continuing on. The Bitcoin mining network, trends composition, average creation costs, electricity consumption, and sources. And this is by Christopher Bendixson, Samuel Gibbons, Coinshares Research at Coinshares Note, this white paper is provided subject to acceptance of the conditions contained on page 18. And let's go ahead and skip on ahead to page 18 and discern exactly what they're talking about here. Conditions 17. Important disclaimer. Please note that this document is provided on the basis that the recipient accepts the following conditions relating to the provision of the same, including on behalf of their respective organization. Should the following conditions not be acceptable, please destroy this document without retaining any copies. This document does not contain or purport to be financial promotions of any kind. This document does not contain reference to any of the investment products or services offered by members of the Coinshares Group. Digital assets and related technologies can be extremely complicated. Cryptocurrencies can be extremely volatile and subject to rapid fluctuations in price, positively or negatively. Cryptocurrencies are loosely regulated, and there is no central marketplace for currency exchange. Supply is determined by a computer code, not by a central bank, and prices can be extremely volatile. And you know what? Coinshares, you really need to get into the habit of referring to prices in terms of exchange rate. Because exchange rate denotes the fact that there are actually two currencies involved here, and we're swapping on apples for oranges. They're not just apples to apples here. Continuing on. Prices can be extremely volatile. The digital sector has spawned concepts and nomenclature, much of which is novel and can be difficult for even technically savvy individuals to thoroughly comprehend. The sector also evolves rapidly. And just to kind of beef up their note there, there's a lot of people that intend to misrepresent exactly what they're talking about, and one of the ways they do that is by coming up with unique nomenclature to refer to exactly what they're talking about. That's why a lot of monkeys, when they're talking about this space or anything that's going on in it, and they say the word blockchain to you, you can immediately assume this person has absolutely no fucking clue what they're talking about. Continuing on. With increasing media attention on digital assets and related technologies, many of the concepts associated therewith and with terms used to encapsulate them are more likely to be encountered outside of the digital space. Although a term may become relatively well known and in a relatively short time frame, there is a danger that misunderstandings and misconceptions can take root relating to precisely what the concept behind the given term is. Oh my god, they just described the fucking word blockchain. The purpose, or DLT. Every time somebody says DLT to me, I think they're talking about a fucking sandwich or something. The purpose of this document is to provide objective, educational, and interesting commentary and analysis on connection with Bitcoin mining, and my mission is to make it sound good. This document is not directed at any particular person or group of persons. This material is solely for informational purposes and should not constitute an offer to sell or the solicitation to buy securities. Although produced with reasonable care and skill, no representation should be taken as having been given that this document is an exhaustive analysis of all the considerations which the subject matter may give rise to. This document fairly represents the opinions and sentiments of Coinshares UK Limited, CSUKL, which is the issuer of this document as at the date of its issuance, but it should be noted that such opinions and sentiments may be revised from time to time. For example, in light of experience and further developments, and this document may not necessarily be updated to reflect the same. The information presented in this document has been developed internally and or obtained from sources believed to be reliable. However, the Coinshares Group, which includes CSUKL, does not guarantee the accuracy, adequacy, or completeness of such information. Predictions, opinions, and other information contained in this document are subject to change continually and without notice of any kind, and may no longer be true after the date indicated. Any forward-looking statements speak only as of the date they are made, and the Coinshares Group assumes no duty to and does not undertake to update forward-looking statements. Forward-looking statements are subject to numerous assumptions, risks, and uncertainties which change over time. God damn, these guys are honest. Nothing within this document constitutes or should be construed as being investment, legal, tax, or other advice. This document should not be used as the basis for any investment decisions, which a reader thereof may be considering. Any potential investor in digital assets, even if experienced and affluent, is strongly recommended to seek independent financial advice upon the merits of the same in the context of their own unique circumstances. Coinshares UK Limited is an authorized representative of Sepia Partners LLP, which is authorized and regulated by the Financial Conduct Authority. FRN 550103. Coinshares UK Limited is registered in England and Wales, blah blah blah. This document is subject to copyrights, with all rights reserved. Use and reproduction of this document or any parts thereof may be done without permission. However, the following citation should accompany any reference to or other use of the information contained in this document. The Bitcoin mining network trends, blah blah blah. Yeah, we got that. So anyway, I agree to these terms. If you agree to these terms, continue listening. If you don't, go ahead and shut it off. But yeah, like I said, having been in this space for a while, which I have. Oh, cool. And the last 2 pages of this are a picture, so we don't have to read them. Anyway, having been involved in this space as long as I have, I gotta say, those disclosures were probably the most honest kind of disclosure they could make. I mean, they didn't really sugarcoat it. They let you know right up front, shit changes, and it does. And anybody trying to guarantee you anything in this space, you can probably instantly assume they're a fucking scammer, because you cannot guarantee anything that you do not know. And we don't know whether or not this shit will just like fall apart tomorrow. There could be like some time bomb in it, and we don't know. I don't think there is, otherwise I wouldn't even be here. Continuing. This white paper is provided subject to the acceptance, and we got that. Abstract. In this report, we investigate the geographical distribution, composition, efficiency, electricity consumption, and electricity sources of the Bitcoin mining network. We also investigate trends in hash rate, hardware costs, hardware efficiency, and marginal creation costs. Among our findings is an estimate that since November, the market average all-in marginal cost of creation at, 5 cents a kilowatt hour, and with 18-month deprecation schedules, has decreased from approximately $6,800 to approximately $5,600, mainly as a result of lowered assumed cooling and overhead costs. This suggests at current prices, the average miner is highly profitable, with even older gear and high-cost producers currently able to make a positive return on investment. Furthermore, we show that Bitcoin mining is mainly located in geographical regions, or in global regions, where there are ample supplies of renewable electricity available. And finally, we calculate a conservative estimate of the renewables penetration in the energy mix powering the Bitcoin network, or Bitcoin mining network, at 74.1%, making Bitcoin mining more renewables driven than almost every other large-scale industry in the world. Introduction. Here in the third iteration of our biannual mining report, we continue our ongoing observations and analysis regarding the state of the Bitcoin mining network. From this report and onwards, we will discontinue any explanatory treatment of mining as a concept and focus entirely on results. For readers wanting to familiarize themselves with or revisit the fundamentals and economics of the proof-of-work mining utilized in Bitcoin, we recommend the following sources, and they give you citations 1, 2, 3, and 4. And those are included, I believe, on page 17 of this. So, continuing. Bitcoin's proof-of-work miners continue to dominate the cryptocurrency mining industry, both in terms of total revenue and total security spend. According to data from CoinMarketCap.io, over the course of 2018, Bitcoin miners received an estimated $5.5 billion in total block rewards. $5.2 billion, 97% of which was newly minted coins. And $300 million, 3% of which were transaction fees. At current, May 31st, 2019 prices and 30-day average fees per block, Bitcoin miners are earning an estimated total annualized return of $6.2 billion per year, 94% of which come from new coins and 6% from fees. The recent increase in the ratio of mining fees as a component of the block reward is an interesting development, and certainly a welcoming development for miners, particularly considering the upcoming halving of the block reward, now less than a year away. Network development. Since our last report of November 2018, the hash rate has grown from approximately 40 exahashes per second to approximately 50 exahashes per second, an increase of 25%. During this period, the hash rate grew slower than the 10-year average, figure 3, but in line with the 5-year average, the beginning of which, 2014, marks the beginning of the industrial mining era. The 6 months past can be roughly divided into two major areas: the final drop and subsequent bottoming out of the hash rate, coinciding with the capitulation phase of the Bitcoin price curve, and the return to growth and near full recovery of the hash rate, coinciding with the recent rally in Bitcoin prices and the onset of the wet season in southwestern China. Meanwhile, Bitcoin prices have more than doubled from around $4,000 to $8,500, which has taken some pressure off the highest cost miners. During the same period, we have observed two substantial macro trends coinciding with the two above interperiod areas. Number one, a large number of bankruptcies, liquidations, and ownership transfers of mining units, often to more well-situated and capitalized miners who are new capital stock has been acquired at a much lower cost basis than their previous owners. And number two, the first at-scale deployment of the latest generation of mining gear. It is also worth noting that the 40% drop in hash rate observed at the tail end of 2018 represents the first time we have ever observed a substantial and prolonged drop in hash rate as a result of sustained large-scale corrections in the Bitcoin price. As we explained in our Medium commentary at the time, number 3, this would not lead to a mining death spiral. On the contrary, the system acted exactly in accordance with its design, with the difficulty lowering perfectly in line with the hash rate reduction, decreasing mining costs in accordance with the reduced reduced Bitcoin prices. Returning to the second era of our 6-month observation period, we believe the recent spike in hash rate is caused by two separate drivers. Number one, the restarting of much of the previously shuttered mining gear, as the Bitcoin price recovery has caused even previous generation mining units to become cash flow positive at the commonly attainable wet season electricity prices. And number two, deployment of next generation mining gear at appreciable scale, predominantly in Sichuan, in line with the advent of the wet season. The efficiency and dollar cost per terahash second both keep improving in line with the 5-year trends, figures 1 and 2. These efficiency gains are contributing to a current all-time high of mining efficiency of 11.5 gigahashes, up from 10.5 gigahashes in November 2018, plus 10%. We also note some jurisdictional developments in North America with consequences for local miners. In Oregon, miners have been facing unwelcome treatment by both local governments and electricity providers, leading to a mass exodus of miners from the state. On the other side of the U.S.-Canadian border, however, previously negative signals towards the industry from both governments and Hydro-Quebec now seem to have reversed, with both added clarity from regulators and less hostility towards miners on the part of utility providers. Lastly, we will briefly touch on the never-ending topic of Chinese mining trends. Over the last few years, we have observed a steady trend of reduction of Chinese geographical dominance. And there's some graphs among Bitcoin miners. However, this latest 6-month period has offered little evidence of that trend continuing at its previous rate. While it is too soon to make any judgment about whether or not the general trend is abating, we offer it as an interesting observation amid the current industry conditions. And I want to pause there just for a moment. They make note of some new miners coming online. But I don't think they're counting that as in the same period of time that we had that 40% drop. See, because there's a period of time between when you have your stuff shut down and when you have your new stuff started up. And you would obviously want the lowest hash rate, the lowest difficulty on the hash rate when you come back online, because that would give you the highest advantage with your newer miners, right? Anyway, continuing on. On the other hand, Chinese dominance in the hardware manufacturing sector remains as strong as ever and is showing no immediate signs of reduction. Even if the most damning rumors of Bitmain's struggles were true, we have our doubts. It would have minimal impact on Chinese dominance in the miner manufacturing sector, as all other relevant manufacturers are also Chinese. Then there is the ongoing uncertainty of Chinese government policy towards miners, latest exemplified by an official note of increased scrutiny among mining. This note caused customary panic in Western media, but seemed to have little actual impact on Chinese miners. It is important to note that Chinese miners already operate in a legal gray area, with large differences in treatment between local jurisdictions, and that concrete, large-scale, coordinated action on the ground would likely be required to effectively uproot miners. We also note that there appears to exist significant differences between local and national treatments of the mining industry, with certain local governments seemingly much more inclined to view the industry positively due to its vigorous revenue generation on municipal levels, with the exception of some miners rumored to be unwelcome in Inner Mongolia and Xinjiang during the last year's dry season. National-level Chinese policy restrictions on mining, at least thus far, seems to be much less of an issue on the ground than we assume in the West. I guarantee you, if you were to go there, you would find that they fucking love miners. Average all-in creation costs, return on investment break-even level. As is customary, we calculate and present our current estimates of market-wide average creation costs, tables 1 through 5. Our current estimate at 5 cents per kilowatt hour and 18-month capex depreciation now stands at approximately $5,600, that is, versus $8,500 in November, Table 3. Also observable in the table, we see that certain segments of miners, particularly those with that highly coveted combination of very cheap electricity, 3 cent kilowatt hours, and gotta go all the way back up to the top of the page here, and brand new next generation gear, potentially enabling depreciation over 2 to 3 years, are able to mine Bitcoin at less than $3,500 per Bitcoin. This combination of circumstances becomes even more powerful if the miner has access to preferential pricing on their mining gear, such as miner manufacturers. Please see page 4 of our May 2018 report for a more detailed discussion of our modeling methodology. Considering the recent relief rally in Bitcoin prices, we believe the mining industry is currently highly profitable with both previous generation hardware, though only at relatively cheap electricity costs, and that's at 5 cents per kilowatt hour, and next generation hardware, even at relatively expensive electricity costs, 5 cents per kilowatt hour, currently able to generate a positive ROI, return on investment. We also note that as a result of the collapse in secondary market pricing of mining gear and large ownership turnover during late 2018 to early 2019, the capex component of the total market average creation costs at 5 cents per kilowatt hour and 18-month depreciation schedule has fallen from 53% at the time of our November 2018 report to 38% at the time of writing. The two other components are hashing electricity OPEX at 54% and cooling and other OPEX, C&O OPEX at 8%. Average cost flow break-even levels. The other important cost level to consider is the cash flow break-even level. As we have detailed in our previous work, 3, this level is critical for estimating the price level below the average miner would have to start shutting down his mining equipment. While return on investment break-even levels are also important, sustained prices below such levels only wipe out miner capital, causing changes in industry ownership ratios over time, whereas prices below cash flow break-even levels cause immediate hash rate reductions. You know, I think this is a mistake on the part of the miners. I think that if they were to be a little smarter about it, they would be retaining more of their Bitcoin, rather than immediately selling it back out to the market in attempts to make immediate ROI. If they were to cause a dividend supply by retaining their Bitcoin for a little bit longer than others were assuming they would, that might cause a little bit of a price spike for them. Continuing, our estimate for the current market average cash flow break-even at 5 cents per kilowatt hour and 15% additional C&O OPEX is $3,300, up from $3,000 in November 2018. We attribute this increase mainly to the 25% increase in total hash rate, tempered by the 10% increase in mining gear efficiency. We also caution that our model operates on the basis of hash rate, not difficulty, meaning that it will tend to overestimate cash and return on investment costs in terms of hash rate growth and underestimate it in times of hash rate reduction. It gives us some nice charts. tables, and we're not going to read them. Table 4, Table 5, Table 6, electricity draw. As of the time of this writing, we estimate the total electricity draw of the entire Bitcoin mining industry to be approximately 4.7 gigawatts. This is the same estimate as in November 2018, but includes a caveat. In our last report, we estimated that miners on average used 20% additional electricity on top of that required by hashing for cooling. We now understand that estimate to be grossly overstated and have reduced it to 10%. Meanwhile, the current amount of energy required for hashing alone is estimated to be 4.3 gigawatts, up from 3.9 gigawatts in November of 2018. This result is also broadly in line with the negative 25% increase in hash rate and a 10% increase in gear efficiency. On an annualized basis, we estimate that the network currently draws the equivalent of 41 terawatt hours. And just a little note on that, there's recently become an increasing trend of liquid cooling. And I think as that comes in, we're going to see these estimates with regard to the mining efficiency and also the energy that's required for cooling to just drop through the fucking floor. It's going to make a lot of places a lot more profitable. Continuing. It is worth mentioning here that as a general principle, the Bitcoin mining network will consume as much electricity as the market is willing to sell it in return for the total value of the block reward, new coins plus fees, minus a competitive margin. This means that increasing the efficiency of mining gear has no impact on the total electricity draw of the network. It can only increase the hash rate per unit of electricity consumed. Over the long term, it is only the value of the block reward that can impact the network's total electricity draw, and I would argue with that. I'm going to argue with that on one point, and it's a consideration that's not a part of this report, I'm sure. But there's been evidence that miners have already been investing in electricity and internet infrastructure in the localities that they are getting into. This alone will cause differentials that they're not able to account for in a report like this and the amount of that they're paying for their electricity. Continuing on. Geographical distribution of miners. Bitcoin miners are fairly well distributed across the globe, figure 6. However, they do have a significant tendency to cluster in certain similar geographies. Looking more closely at their distribution, it is clear that they are predominantly by volume weight confined to technologically advanced, relatively sparsely populated, hilly or mountainous regions traversed by powerful rivers. Among these regions, we find the majority of mining centers of Washington and New York states in the United States, British Columbia, Alberta, Newfoundland and Labrador, and Quebec. Let's see here. It gives us maps. Cool. Provinces of Canada, Iceland, Northern Scandinavia, Norway and Sweden. The Caucasus, Georgia and Armenia, Yunnan, and most importantly of all regions, Sichuan provinces of China. There are also minor mining centers found in similar geographies such as Austria, Montana in the United States, Guizhou province in China, and the Siberian Federal District of Russia. The remaining major mining regions which do not fit into the above geographical mold are Iran and Xinjiang and Inner Mongolia provinces of China. Minor mining regions where the above described geography does not, or where we cannot be certain that it does, fit the above description include Florida, Texas, and Arizona in the United States, Western Australia and New South Wales states of Australia, Belgium, Belarus, the Northwest Federation District of Russia, Argentina, Venezuela, and Israel. and Israel. See map for list of sources. Energy mix. Building on our increasing visibility of the mining industry as a whole, we continue our ongoing reporting on the likely energy mix of the input energy in the mining industry. Again, we refer back to our previous reports, in this case, page 5 of our November 2018 report, for a more detailed discussion of the methodology and background of the investigation. For more casual readers, however, we summarize our methodology in simplified terms below. Our main assumption is that miners, wherever they are located, utilize the same mix of power generation, fossil/nuclear or renewable, as the average reported in their region. We then estimate the total percentage of hash rate residing in each relevant region down to the lowest administrative subdivision for which reports of energy mix are available. Finally, we multiply the percentage of renewables penetration in each relevant mining region with the percent of the total global mining industry residing in that region to arrive at a global weighted average estimate of renewables penetration in the Bitcoin mining network's total energy generation. From the previous section, Geographical Distribution of Miners, readers will note that the divided geographical clusters of Bitcoin miners into two main baskets. We call the first basket the hydro regions, and the second basket the non-hydro regions. The hydro regions, as implied by the name, are global regions of hydropower abundance. In the remaining regions, we observe a mix of fossil, nuclear, solar, and wind generation sources, with some, such as Iran, dominated by natural gas, and others, such as Xinjiang and Inner Mongolia, dominated by coal and supplemented with wind. While there exist miners using solar as their main power source, such operations are still relatively rare. We currently estimate that 60% of global mining happens in China, and that Sichuan alone produces 50% of global hash rate, with the remaining 10% split more or less evenly between Yunnan, Xinjiang, and Inner Mongolia. Our estimate for Sichuan's dominance within both China and the world is marginally higher than in our last report, and is a result of the feng shui rainy season, or feng shui, not feng, rainy season, and the hydro-heavy, colloquial name for Yunnan. I guess it's Yungui Chuan? My apologies. It's a colloquial name for Yunnan, Guizhou, and Sichuan here, awkwardly in Latin alphabet, provinces of southwestern China. During this period, electricity prices are among the lowest in the world, making it one of the most attractive global mining regions available. We expect this estimate to drop in our next report, November 2019, as many miners migrate towards Xinjiang and Inner Mongolia for the dry season, but more on that in the next section. Out of the remaining 40% of miners, we estimate that 35% of global hash rate production is evenly split between Washington, New York, British Columbia, Alberta, Quebec, Newfoundland, and Labrador, Iceland, Norway, Sweden, Georgia, and Iran. The last 5% is assumed to be distributed widely enough that the global average energy mix is a good enough fit to estimate their energy sources. These estimates and the corresponding regional renewables penetrations are summarized in Table 9. Using the above methodology, we arrive at a new lower bound estimate of 74.1% renewables penetration in the mining energy mix. The reason we consider it a lower bound is that we believe our methodology to be highly conservative in its treatment of certain regions where we know miners are using renewable energy sources, even though the regional average is less than 100%, such those in New York. The renewables estimate is down from 77.8% in our November 2018 report and reflects increasing visibility of the industry on our part, as well as movements within the industry. For example, we have observed a significant exodus of Oregon miners, as well as an influx into natural gas-dominated areas such as Iran. Seasonality factors of the energy mix. As we have alluded to in previous sections, we continue to observe moderate seasonal mobility, especially among Chinese miners. We believe this mainly to be the result of the seasonal variability in rainfall and consequently hydropower prices. In the Yangguichuan region of southwestern China, the annual, quote, feng shui or wet season period manifests. Electricity prices fall as low as 2.5 cents per kilowatt hour, and generally to levels that are among the lowest in the world. Multiple sources suggest that more than 100 terawatt hours of electricity could be wasted annually across these three provinces alone. When the dry season returns, electricity prices rise again, causing some miners to migrate to Xinjiang and Inner Mongolia, where cheap coal and wind power is available year-round. Some sources suggest that as many as 500,000 mining units migrated to and from Xinjiang last year. Migration, however, is an expensive endeavor restricted to the most well-capitalized miners, with seven-figure relocation costs and 20% breakage rates reported. Combined, these migration patterns will cause seasonal variability in the renewables penetration of the Bitcoin mining industry. We therefore expect our estimates of total renewables penetration in the mining energy mix to vary somewhat with the seasons. Caveats and uncertainty factors. It is necessary at this point to caveat that while we do our utmost to accurately pinpoint the location of global mining centers, the Bitcoin mining industry remains a highly private and secretive industry. As a result, our estimates may be subject to significant potential uncertainty. While we have made no attempt to formally quantify these uncertainty levels, we intuitively guesstimate that ergo our renewables penetration figures should be taken to include a tentative uncertainty of around plus or minus 10%. That being said, we confidently consider our numbers to be the best available in the industry. For other estimates using survey-based methodologies, we refer readers to the following sources, and it gives us some citations there. Conclusion. The Bitcoin mining network continues to develop along its 5-year trend lines on metrics of efficiency increase, investment cost reduction, and hash rate growth. After having emerged from one of the most challenging price environments ever observed and it gives us some charts in the industry, miners now appear generally healthy and profitable at current price levels. Over the last 6 months, we have observed significant liquidations of miners and a high corresponding turnover in mining gear. While this has certainly been painful for the eliminated miners, the remaining ones are now much better equipped to handle further market downturns should they emerge. Miners are still majorly confined to regions dominated by cheap hydropower, such as Scandinavia, the Caucasus, the Pacific Northwest, Eastern Canada, southwestern China. We believe this to be a direct consequence of the extremely low electricity prices available in these regions, especially where the hydropower is relatively underutilized. Goddamn right it is. Where we previously had observed a strong tendency of miners moving out of China, the preceding 6 months have not shown many signs of this trend continuing. Here we also want to caution that the arrival of the Feng Shui wet season may be a complicating factor, as Chinese miners would likely be unwilling to risk international relocation in the face of upcoming boons in domestic electricity pricing. The migrations we do observe are mainly confined within China, where miners will opportunistically relocate their gear between Xinjiang, Inner Mongolia in the dry season and Sichuan, Yunnan, and Guangzhou in the wet season. While this is certainly an interesting pattern, certain factors such as high relocation costs and breakage rates seem to act as dampening factors to overall migratory behavior. I think there's a little factor you're not counting in there. They're very, very keen on statistical process control over there, and so this 25 or 20% loss due to breakage, it might be a stealth way to upgrade their miners in transit. Continuing. Finally, using a combination of estimates of global mining locations and regional renewables penetrations, we again calculate the Bitcoin mining industry to be heavily renewables driven. Our current approximate percentage of renewable power generation in the Bitcoin mining average energy mix stands at about 74.1%, more than 4 times the global average. This estimate is marginally lower than our November 2018 estimate of 77.8%, reflecting the upstart of major mining clusters in fossil-dependent regions such as Iran, as well as relocation away from hydro-dependent regions such as Oregon. Overall, our findings reaffirm our view that Bitcoin mining is acting as a global electricity buyer of last resort, and therefore tends to cluster around comparatively underutilized renewables infrastructure. This could help turn loss-making renewables projects profitable, and in time, as the industry matures and settles as permanent in the public eye, could act as a driver of new renewables developments in locations that were previously uneconomical. Goddamn right! I think they're onto this shit. Let's see. There's all kinds of little tidbits of information that they refer back to, starting at page 11 and going on down. So it's a pretty comprehensive report, and I think we did a good job of covering it. So there's our disclaimer again, and yeah, like I said, I think this is a pretty solid report. I think there were some omissions there that they couldn't possibly account for. It's like if there were a group of people that were to get together, myself included, of course, that were to lobby in certain areas where there are things like rivers. Okay, if there's a place where there's a river and there's no like hydroelectricity being utilized on it, I think there happen to be very non-invasive ways to intersect inline segments of where we could be drawing electricity out of rivers. Okay, of course that means that the water has to continue to flow as a river. But the point being that the energy is there. I see it every day that I'm looking at this river and I'm thinking like a million different ways that the electricity could be harvested, the energy could be harvested without significantly disrupting the river itself. Maybe even adding to its structure as well as ecological bounty. But it's like, we think in these really limited terms with regard to energy production, and I think that's such a fucking bad thing. I think that we need to be progressing towards utilizing every little bit of energy that we can possibly draw out of our surrounding area to make that end of our life cheaper. I mean, electricity should basically be free. I mean, if you can get it down to 5 cents per gigawatt hour or whatever, I mean, come on now. If you can get it down that low, we can get it down to free. And just like there's a balance to the cost of, say, oil, right? That you do certain things on your investment end to get an outcome, right? And so things like fracking can pencil out, because after you've refined the material that you pull back out of the well and you've gotten the oil out of it, the economic activity that's enabled by those hydrocarbons that were yielded from that material makes pulling it out of the ground in that way worth it, right? Now, what if you don't have to do that, though? What if just by trying to capture some energy from a flowing body of water in front of you there in a fucking form of a river or a lake or a stream or a creek even, and capturing that energy, I think you could turn energy so cheap that the economic activity that it enabled would make it worth it to do. And again, we're talking about mining here. Why I live in Oregon. Why mining should leave Oregon is beyond me. Like I said, we've got free energy flowing all around us. We've got some of the windiest fucking coastline on the entire North American continent. But what are we doing with it? Virtually nothing. I don't understand that. We've got raging rivers all around this fucking state. How much penetration do we have in investment in hydroelectricity, both private and commercial? Not all that much. Certainly much less than there should be. I mean, as far as I'm concerned, Oregon should be like an economic electric producer that's like lighting up California, fucking Idaho and Nevada, and we should be selling electricity to all these places. There's so much fucking energy flowing around us here in nature that it's perverse that it's not being utilized at all. But I think that the problem is that a lot of the people that would want to invest in it, they're not exactly as ecologically conscientious as we would like them to be here in Oregon. And so, I think that, if people really put their heads together, like I've got a few ideas in my head as far as like how to draw the energy out of the river and how to produce the electricity that I believe would be actual improvements to the river itself. And we're not talking about a process that includes a lot of toxic chemicals or anything like that. So, again, why we're not utilizing our energy sources in that way to those ends, I have no idea. But this report certainly would give us a little bit of an insight in the kind of incentives that are involved here. Anyway, let's go ahead and throw back down into some music. I got some Meshuggah playing, and I have not played any Meshuggah this evening, so we're going to have to resolve that. And so, where are we going to go with it? Meshuggah. Let's go with Clockworks. And this is off the Violent Sleep of Reason by Meshuggah, here on Coin Metal. And that was Slayer. And I didn't bother to check what song it was. It was actually went over what I had intended. But it is with that I'd like to bring this episode to a close. Thank you very much for listening. I certainly do appreciate the support. We will be back again on Monday at 8 p.m. Pacific Standard Time. So until then, I want y'all to trade safe. Do your homework. And watch out for your own bunghole, because nobody else is going to do it for you. As far as our last dance is concerned, I hadn't played any Irreversible Mechanism, but I don't think I want to go there. I think we need some Judas Priest. Electric Eye, Last Dance, here on Coin Metal. Thank you again for listening, and y'all have an excellent weekend. Good night.